Hey everyone, so in this section I want to talk about supply and demand. They're also known as order blocks. It's the exact same thing. To me, supply and demand is just a little more accurate to what it is. Ultimately, the market's always in a battle between sellers and buyers. And the concept is if we're in oversupply of something, and price is really high and premium, that we're likely going to be selling. Now, if something is highly in demand, we're likely going to be buying as more of it is needed. That is the simplest ways to explain it in terms of traditional market terms. If corn, let's say, is in oversupply, you're going to be looking at selling it. If corn's in demand, you're going to be looking at acquiring it. Well, the same concept applies to supply and demand in the Forex side of things. If we are selling, we're looking to sell off a supply zone. If we are buying, we're looking to buy off a demand zone. Now, there are several different ways to draw these and map these, pull these. I'm going to show you a couple different ways. How you choose to do it is completely up to you. You're going to learn to refine these as you start using these yourself and see what works for you. Just to give you an example here, the traditional supply and demand taught us that we pull the last up candle before the downward candle, and that is ultimately a supply zone, or also known as an order block. That is 100% correct. For myself, I will pull the bottom of the body and top of the wick. I will not pull this bottom wick. Some people can and will pull the bottom wick. If you want to do that, that's totally up to you. Now, the supply and demand concept expands a bit. A lot of people will pull ranges as supplies and demands, and I will if they're pretty tightly knit. Now, if the range happens to be, really wide or something silly, I will find a candle that's a little more prevalent, and it's usually the candle before momentum is a good way to map supply and demand zones. At times, ranges are going to be your best supply and demand. At times, you're going to have these beautiful candles that get engulfed and make it really easy. And other times, you're going to have, pretty ugly supply and demand zones, if I'm going to be honest. But you will learn different ways of pulling it. And ultimately, there's no wrong or right. And if you're not sure, pull a bigger zone than you need, because you're ultimately going to be playing the reaction off this zone, how it reacts, what took it out. So to give you an example, up here we have your initial supply zone. Now let's take a look at that. What can you actually see? Well, this supply zone actually gets mitigated by this wick. So to me, in this area, I would refine this supply zone to this wick. As the area up above has been mitigated, this is the unmitigated zone. So to me, that is the most prevalent supply zone on the 4 hour. And these zones are pulled the exact same across any time frames. What you're going to find is ultimately what works for you. I like wicks, I like bodies, I like ranges, but I will ultimately refine it to the tightest zone that I can. And the easiest way is just put some back testing in and find what works for you. So on the demand side of things, I usually start off with pulling the top of the body to the bottom of the wick. I won't pull the top of the wick, whereas a lot of people will teach to pull the top of the wick, and in this particular case, you do get a reaction off of it. Again, that's totally up to you to test. Now, the other thing I want to talk about is sell to buy wicks. And what sell to buy wicks are is these little areas in here, and what they are actually is a supply and demand on a smaller time frame. So let's say we pull let's find one here. Here's a prime example. So we have sell the buy wicks here. I want to mark that as supply. Now we can't really see exactly what it is on the 4 hour. In this case, you could even say the sell to buy wicks have been mitigated and this wick is your prevalent supply zone. But for the purpose of this example, we're just going to leave it on the sell to buy wicks, and let's go down a couple of time frames and see if we can find exactly what it is. So now you have a bit of a doji here on the 2 hour, and on the 1 hour you have your candle, and ultimately that's your sell to buy wicks. As you can see, it's been mitigated. In this case, to me, it's this wick that gets mitigated, and you can refine these zones if you go down time frames quite accurately. And again, there's no wrong or right way, but always pull a bigger zone than you need if you don't know. But ultimately, always the candle before momentum. So something here, like I would pull a supply zone like that. Now if you drag that across, you didn't really get any kind of a reaction from this. We went right through it. Whereas if you pulled the whole range in this area, then you would say you did get some sort of reaction from it. If I include this wick and everything. Now what this would be is likely a supply zone on a bigger time frame. So if we go to 12, maybe even to daily. So these are your daily sell to buy wicks. So it's probably whatever it is, a 12 hour, 16 hour supply zone. You don't really need to get too caught up in all these time frames. For myself, the majority of everything's done on the 4 hour to 15 minute, and then I'll take a look at the daily, but I don't sit there and start pulling an 8 hour supply and a 6 hour supply and a 45-minute demand, and it's just not necessary. What I will say is I will investigate what's there. If I, for example, sell the buy wicks here, we had sell the buy wicks on the 4 hour, I'll quickly investigate on 2 hour, 1 hour, and just try to pull a more accurate zone if I'm not sure. And ultimately what you can expect from these supply and demand zones is you'll either get a reaction and bounce off of them, or you'll go through them and you'll run the high. Well, as soon as the highs run, you can expect a retracement, and that's because the liquidity has been taken. And they're good for a couple of reasons. In a bullish scenario, you're looking to run these highs, so you expect this supply to fail. In a bearish scenario, you would be selling off these supply zones, and you'd actually be looking to run demand zones, so you would expect supply to be holding. So we're always in a constant battle of supply and demand. So the best way to think of it is who's in control, supply or demand. So just looking at this, we have our swing low here, swing high here. This is your 4 hour demand zone, currently in control. And as long as this low stays intact, 4 hour is bullish. Now, when we go to fine tune things, we're obviously not going to be sitting on the 4 hour alone taking trades, but you'll start noticing how supply and demand interacts with each other, and ultimately where you can start framing trades off of. And this is something that you'll have to test for yourself, but you'll see which zones hold, which zones don't, why they hold or why they don't. And you will get to a bunch of areas like this, and you're probably like, well, which zone do I pull? What do I do? And myself, ultimately, I would probably just find a range like this and kind of pull the whole area, because I don't know which candle it's going to react. What I do know that when we hit this vicinity, we expect some sort of reaction. Whether or not the reaction carries on through, goes on to make a high, that's completely up to the market. Now, if we stack this with our premium and discount tool, we can start formulating the idea of maybe we want a better deal on our investment. So in that case, that puts this demand zone right at 50%. And if we're going to be buying, we prefer to buy below the 50. If we're going to be selling, we want to be selling above the 50. Now, the demand zone it reacts to here happens to be in discount, well below the 50%, well priced. This makes this demand a much better choice. This is something you'll ultimately have to test and see how they react, but what you can be assured of for sure is that certain zones will be stronger than others. And the question you're going to have to ask yourself is, why are certain zones stronger than others? And the easiest way I can explain it is, what did that supply or demand do? Was that just a supply or demand that created some new substructure, or did it barely do anything? Or was there a flip zone where the demand ultimately took control from supply? The flip zones I find are usually little stronger zones. If they made new market structure, which this one I believe did not, it created more of equal highs. But usually if a demand or a supply goes on to create new market structure, it is a stronger zone. So to go back to our 4-hour example here, we have this demand zone, you had market structure here. So you had our 4-hour structure, and you had another point of 4-hour structure up here. Now ultimately, this demand zone goes on to create a new high. We're bullish. As of right now, this to me is a strong demand. Now, on the flip side of things, we start looking at this and we start seeing that this low is weak. It could not take the high, so it gets run. Now we take another run at the high. Ultimately, it wasn't able to run this high again. So now I could start playing with the idea of maybe supply's holding and maybe this low's becoming weak, and I can start building a trade narrative off that. But as of right now, we're bullish on the 4-hour unless this low goes. So on the trade sense of things, you would be basically looking at how the 15-minute reacts. And ultimately, that'll be your micro for your macro. Meaning if the 15 minutes starts going up, you're going to likely follow it up till it fails. If the 15 minutes starts going down, we're going to assume that that low is going to be letting go. And that's kind of how we play the market together. On the higher time frame, this particular pair right now is bearish. So my expectation is that even if the 4-hour trend does continue the bullishness, it's likely going to stop and not take this high, because that's your last swing high. Put in this low. So even though we are bullish, I know that the 4-hour trend is likely going to end because daily bearishness trumps it. And ultimately, if the trend reverses on the 4-hour, we can say that this low becomes weak and we'll be running it. More about this concept will be in the weak points and strong points video. But for now, I just want you to get familiar with pulling supply and demand zones and what they are. And basically, anywhere price moves away from abruptly, anywhere price rejects, is likely a supply or demand zone. As I said earlier, the best ones either create new market structure or at least break substructure, if nothing else. Or they cause the flip, but ultimately those are the best zones. You'll start getting into this and you'll be looking at it and, oh, we have a you know, we have supply zone, supply zone, supply zone, supply zone, but they're all failing. And ultimately, you look at this and you'd be like, okay, well, demand zone, demand zone, demand zone, they're clearly in control in this particular section here. As I said earlier, the best ones usually do something. If the supply or demand does absolutely nothing, it usually isn't as strong of a zone, or it'll be used as liquidity for later. So for example, here you have a little bit of a supply zone, but it really doesn't run these lows. It didn't really do anything. So the market blows right through it here, and ultimately you have a flip zone. You had a supply here, and demand took control here. And on the lower time frame, whether it be the 1 minute or the 5 minute, whatever your entry time frame may be, you would be looking for entries in there. Now when we get to the entry section, I will be showing different ways of entering on the 1 minute, the 5, and the 15. Obviously the lower you enter on, the better the risk reward, but the lower your hit rate will be. And we do have a tool to combat that called change of character and flip, and ultimately we'll show you the higher probability ways of getting into a trade. But for the time being, I just want you to get familiar with supply and demand and what they do. For example, here we have a demand zone that went on to create a new high. It is, you would think this is a strong demand, but if you actually zoom out and look, it actually it took this 15 high, but it never created new higher time frame market structure. So when we did come to it, it could have held, it could have not, but the second you see a flip zone and this demand zone lets go, you could start building a narrative that this may continue on down. And that's ultimately what we look at the market as, that either supply or demand is in control. That's about all there is for this section. These zones are very subjective. I don't know how many different coaches along my journey and how many different mentors I went through that showed me every which possible way of pulling them. And the truth is none of them actually know. What we do know is if price initiates away from that area, when it taps into it, we'll likely get some sort of a reaction. Now, if you pair that with order flow and market structure and liquidity and all that good stuff, you can usually form a higher probability trade. So we will cut this video here, and I will see you guys in the further